Hello everyone, my name is Steve from the General Finance Institute. Welcome to another lesson about corporate investment decisions. I hope everybody's doing well. We'll be talking about the net present value, or simply NPV today, as it relates to choosing whether or not our organization should invest in a project. As you know, money's value changes over time. You can test it yourself if you are not sure. Let's suppose that we will give you $1,000, and we are giving you the choice either to have it now or in 3 years. Even without any financial background, I bet that you chose to receive it today. So you would have the opportunity to invest it for 3 years to come up with an amount that is superior to the $1,000 initially given. Just like you, companies seek to maximize their wealth by taking into account the value of money over time. To do this, they will opt for a calculation that reports all cash inflows, net cash flow, and outflows, initial investment, to today's date. The net present value is calculated in 4 essential steps. 1. Determine the entry value of the investment. 2. Calculate the discount factor for each year. 3. Multiply net cash flows by the discount factor. 4. Subtract the initial investment from discounted net cash flows. Let's use an example to put these elements into practice. As a new recruit at ABC, a company specializing in motorcycle manufacturing, you have been asked by the CFO to analyze a proposal put forward by the production manager to build a new model with a high profit margin. They give you the information below. Investment, $2 million. Startup costs, needed to start the business, $200,000. Net cash flow for year 1, $300,000. Net cash flow for year 2, $350,000. Net cash flow for year 3, $480,000. Net cash flow for year 4, $700,000. Net cash flow for year 5, $800,000. Discount rate, 5%. So let's start with the first step, which is to identify the value of the investment. It is obtained by adding together the investment required and the costs incurred at the start of the project. So in this example, it's the investment plus the startup costs, which gives us a total of $2,200,000. After that, we calculate the discount factor that corresponds to the number 1 multiplied by 1 plus the discount rate raised to power n, which is nothing but the year in which the net cash flow is generated. So for example, the factor for year 0 is 1 divided by 1 plus r power 0, which is 1. The factor for year 1 is 1 divided by 1 plus r power 1, which is 0.95, and so on. The table presented gives the calculation of all the factors and their values. The third step is simple. It consists of multiplying the cash flows by the discount rate, as shown in this table. The final step is to subtract the value of the investment calculated in step 1 from the outputs obtained in the third step. This will allow us to evaluate this project. If the NPV is positive, which is the case here, it means that the project is creating value. If the NPV is negative, the project will be rejected as it destroys value and weakens the entity.